Good afternoon, and thank you for joining us for the Allied Association hosted ITR Economics webinar presentation, Managing Uncertainty, How to Handle Black Swans in the Economy. My name is Dawn Parker, and today's webinar is brought to you by CFESA, FCSI, FEDA, MAFSI, and NAFEM. Health concerns, a dramatic decline into correction territory for the S&P 500, and declining oil and copper prices have combined to create a high level of uncertainty about what to expect from the economy for the remainder of the year. Today, we will learn what precedents we can look at that give us some idea of what to expect, and if recent events suggest that a bona fide recession is unfolding for 2020. We will also discover what economic signals we should be looking for and cover what we anticipate seeing in the months ahead. If you have questions during today's presentation, you can send them to us using the question function in your webinar control panel, and we'll answer everything we can within our allotted time. Today's webinar is presented by Alan Beaulieu, President and Principal of ITR Economics. Alan has a reputation as an accurate, straightforward economist and has been delivering award-winning workshops and economic analysis seminars in countries across the world to thousands of business owners and executives for the past 30 years. As the co-author of Prosperity in the Age of Decline, he is one of the country's most sought-after economists and a good friend to all of our organizations. Welcome, Alan. The webinar floor is yours.
Well, thank you, Dawn. That was very nice of you. And hello, everyone. I hope you are well wherever you may be today. We do have a lot to talk about. And as I look at the cover slide here with uncertain in the title, I think, my goodness, that may be an understatement. I should probably have done a thesaurus look and see what else I could have come up with besides uncertain. I was just looking yesterday and saw a forecast that said this was going to be a severe recession, worse than 2009, and it was going to last for years. I thought to myself, my goodness, how does anybody get out of bed when you have that kind of feeling that's upon you? We're going to sort through all that today. We're going to go into why our forecast is what it is, what we were thinking, what was guiding our thoughts. We're going to end up with a forecast that will help you see your future, will help you see what you can plan on and what you can know, at least as far as information is available, and things that you should be watching as you go forward so that you can have a confidence in this unfolding in the way that we talk about today. And I do look forward to your questions. As Dawn mentioned, those are very important to me, so please make sure you ask them, and I'll do my best to get an answer to you. We're going to start off talking about some things that, I'm not an MD. So I just want you to know we're going to talk about COVID-19 and government involvement, and from a economist point of view, the COVID-19 discussion can be very, very sensitive to a lot of people. I just want to talk about it in terms of numbers and trends and statistics. And it may seem like I'm cold to the human suffering, to the human content. I'm not trying to be, but I'm not here for that either. We're going to talk about the government involvement that followed on, and the stimulus packages and fiscal policies. We'll deal with that as we go forward, monetary policies as well. And we're going to look at oil prices, and then we're going to put all that together and come up with some assumptions and look at economic variables, and hopefully leave you with a way of seeing the future, a way that will help you to navigate that future. It won't be all pretty, but we think that you will get through this with some careful planning, and that you certainly have good days ahead. We want to make sure that we cover that as well. All right, so let's get to work. COVID-19, every day in the news. We're talking about it here at ITR Economics every day of the week, numerous times a day. I thought you'd like to see this, sort of set the stage before we go forward. You can see that rectangle there in that, I'm not sure what color that is, let's call it brown, and show you where COVID-19 fits on the scale of fatality rates, bird flu being at the top there, Ebola, MERS, you can read what's there. Not nearly as bad as that, but we are above the seasonal flu in terms of its fatality rate, not by a lot, but some, and in terms of its contagion, pretty much on par with the common cold. So all in all, this is serious, but I just want to put it in perspective because I run into people who say, well, you know what, this is going to impact 30% of the population in the United States. And I'm just dumbfounded by that. I don't know really where that number comes from. It could be the exponential 2.5. They talk to 2.5 and it just goes out from there. So after a month you have a million, after 2 months you have many millions. But there's nothing going on that would suggest that. There's nothing happening so far that would suggest we're going to see a 30% infection rate in the population. Just to put that in perspective, I don't know where you're all from, so I can't do all your states, but I'm sitting in New Hampshire right now, and 30% of the population of New Hampshire would be right around 400,000 people, a little over 400,000 people. So the state is actually planning for 400,000 people in this little state of New Hampshire coming down with the infection, and therefore swamping hospitals, and they're commandeering schools and all the rest of that, and setting up makeshift morgues and such. I'm thinking, that's absurd. That's not happening anywhere else. We look at the global numbers and you don't see anything like that. So I'm not sure where that kind of math comes from in terms of solid planning. I just would like you to put it in perspective, please, that that's not happening. It certainly is deadly in some places. When you look at the fatality rate in Italy for the last week at 11%, so 11% of all people who contract the virus will pass away. And you can see that fatality numbers of people in terms of the percent of the overall population. The right-hand column is really important here though, and that's the number of people over 65 years of age in Italy. And you can see there's a relationship there. This is a disease that does seem to attack the elderly with more frequency, with good reason. This is a comorbidity factor. So in nursing homes among the elderly, much more ready to have a respiratory problem brought on by the disease, compounding with other problems, and therefore increasing the fatality rate. Spain also has a high fatality rate, but as you dial back down that column, though, you notice the United States, we have a fatality rate of 1.75%. There's actually, people out there that think it will be much higher than that. Nothing to indicate that at this point. Our population is not especially elderly. Certainly, most countries have a smaller percentage than the United States, but nevertheless, we find ourselves with a fatality rate. Again, I don't want to sound cold, but it's pretty light compared to a lot of other countries. And so, as we put this in perspective, we're kind of coming down on the side of let's not panic over this. It's too late. We have stay at home. We have shelter in place, we have businesses closed, and so you and I are going to move from this reality into the reality that is actually upon us. But I just wanted to start with this so you could see the numbers, so you can get a feel for what's real and for what's not real. If you're in New York City, obviously you know that you're a hotspot of activity, not a lot of staying inside, not a lot of social distancing compared to other cities, is what I'm hearing and seeing. If you're in Montana, it's an entirely different situation. So it really does depend on where you are, how you feel about all this. Putting it in perspective though, this will pass. US experts are saying that the peak will come in a couple of weeks. Let's call it mid-April. And then we're on the backside, which means the death count should start going down and we should start seeing number of infections begin to lessen, and we should find ourselves on the backside of the slope. There's an interesting graph that I just came across today, didn't have time to put it into the presentation, that shows the number of new infections globally is actually on the decline, while the number of recoveries is rising nicely, rather sharply. So as those two lines come together, they will pass someday, and you know you're clearly on the backside of the not business cycle, but the infection cycle. We're getting there. This is not going to last for years. Infections, come and go. This one's likely to be seasonal. We hear talk of vaccines the same as you do. We hear talk of everything from new testing kits coming out from Abbott's lab, 50,000 a day, to new vaccines being produced in Europe. We'll see how that all transpires. My point is just, again, it's a reality check. Don't look beyond the numbers that would call for a much milder infection rate, and therefore much quicker recovery rate on the other side for the economy. Let's move to China. This is where it all started. So let's start there. As we look at China, we see that they are operating, at this point, it's actually close to 70% of manufacturing capacity and 90% of labor has returned. We expect, and they expect, not just ITR, but they expect to be at 90% machine capacity utilization. And when this was first handed to us, that would mean by the end of April. As I've talked with clients, that is certainly the case. I just had a client call yesterday where they had 75% of their labor back, not 90%, but they were at over 100% output from their plant because of efficiencies that they have been able to use. So with less labor, they're producing more. We know ships are coming. We know that they will be bringing product to the United States. Supply chain is an issue, but it is a clogged pipe that is clearing up. And as their ports get busier, as ships are coming, we're going to find that there is an easing in that supply chain problem that is coming. And businesses that have seen this and stocked up on inventory, got their orders in, got their product in early, will certainly be the ones who do better, or the ones who can switch to a North American source. And that's likely to be one of the fallouts from this, is that we find that a lot of businesses seek North American sourcing. Doesn't necessarily mean the United States. But as we look at North American sourcing and what that means to a stronger North American economy, it's good news. It means that you have more jobs, you have people earning more money, you have people spending more money on the things that you do, which is certainly good news. When we look at the the return of industrial firms that are open, 90% in the province, it's certainly good news. President Xi said it's time for them to open up. Government is working this. Provinces are seeing this. You will see it soon in the United States. You'll start hearing more about it in the United States. We get a question a lot. Will this cause a lot of trouble for China in terms of our 2030 Great Depression forecast because they're already debt heavy? We don't think so. As we look at the debt of the provinces, which is where most of the debt is, and we look at how this turnaround is happening in fairly short order for China, it is not a threat to the 2030 forecast. For those of you that know what I'm talking about and have heard ITR speak at one place or another, you know that we are forecasting a Great Depression, global Great Depression in the year 2030, certainly here in the United States as well. That's that book that Don mentioned that my brother Brian and I wrote called Prosperity in the Age of Decline. Number one question we get, will this bring the 2030 depression up? Has it actually started now? And the answer to that would be no. And just thought we'd take that off the table. Don't worry about a Great Depression starting out of this. China is showing that this is of finite duration. You look at South Korea, you're seeing that they're handling the virus rather well, and they're not having the same impact that Italy and Spain, for instance. Taiwan's the same story, aggressive handling of the impact of the virus. And they're finding themselves passing through a trough in rather short order. So as we model after China, in terms of the timeline, we come up with part of our thinking for the US, which I will get to in a little bit. But this is certainly part of it. China's recovering. And as they are recovering, it certainly is good news for us. And we will soon find the medical facts catching up to the economic facts, I trust, and that there will be vaccines that will be out to the population, probably more than anything in time for the next outbreak when this becomes, flu number 3, flu number C, letter C, whatever they want to call it, and we just have to have an arsenal of drugs ready to deal with it. China's not going to bring the world down. It's actually showing us a path where the world is going to do better in the future. And the world was ready to do better. This G7 leading indicator, this red line, is showing us that we were primed to see world industrial production move up. The fundamentals were all in place, and then COVID came around. What a disappointment. That red line is not being published right now. There'll probably be a couple months before it is published, but it would not be surprising to know that it has gone down. But if it goes down, we expect that it's going to bounce right back up because those fundamentals were in place and nothing has destroyed them. So look for the world economy to improve, China leading the way, if you will, because the data is available. We're going to find that in a few minutes, we're going to look at some leading indicators telling us that we should expect to see the US economy pick up. We'll talk about when. But remember that red line. That red line is saying that things were getting better. We were just about ready to see all this trade war pressure, all the things that were disturbing us fade into the rearview mirror so we could go forward in a stronger, better way. Now we're going to switch to the United States and what's happening at the federal level. You and I are living history. This is an incredible amount of history. The CARES Act of 2020 is something we'll be talking to our children and our children's children about for a long time. When we look at $2 trillion in stimulus, it's absolutely amazing. We did not list out the particular report items separately, just the headline items, and you can see there's lots of money in there for the different groups. When we look at small businesses and the SBA loans that are there and the paycheck guarantees that are there, there's actually some very good measures that will help small businesses move forward. Mortgage deferments are certainly very important. At the personal level, many states have made it impossible for individuals to be dislodged from their rental units. There's no foreclosures likely to go on because you can get a deferment on your mortgage from most places. So with the deferments and the inability to evict somebody from their premises, it's going to be a challenging time for individuals. The extra unemployment payment of $600 from the federal government is going to go a long way towards easing some of that pain when those checks start coming in. The immediate check of $1,200 per person and more with children is going to provide some short-term relief when those checks get here. And that's probably all we're going to need because we're not seeing this last a long time. Again, we'll get to that, but as we see unemployment benefits getting to people, as we see cash payments getting to people, this will help take some of the sting out of it. And you and I both know that you need consumers with cash, consumers who want to spend, consumers who have to spend. And that will be a key component to things getting better for you and for this industry. Large corporations among us will find that there's some help. My intuition is that most of us will be small business minded on this call and worried about individuals, our employees, and what they are going to do. And there is help coming along the way. If you elect to do the PTO for 2 weeks and then 2/3 pay, there's some money to guarantee. There's some money that will be given to you, and I use the word on purpose, because you will not have to pay it back if you fall within certain guidelines, and you're doing that. It's a well-orchestrated plan. It's a question of whether they get it done in time. If they take 6 months like they did in the last Great Recession, then it'll come largely too late. It'll be anticlimactic. If they can get it out fast and roll it out quickly, then it will certainly help bring the economy back. It'll also have a significant impact on the future because $2 trillion is not a small amount of money, but it'll be added to the federal debt. And that's a problem that the millennials will deal with in the 2030s. When we look at food service contractors employment, this is before all of this started. You can see the rates have changed. The top two trend lines were going down. It was hard to get help is what's going on here. And as it was hard to get help, the number of people working in this industry was slowing in its rate of rise. And that's going to continue to be the case. I'm showing you this because my advice to you is to be very careful with the concept of layoffs. There may be some C employees that you want to lay off. There may be some cuts that you have to make, but that doesn't help you when in the 2 quarters from now, well, 3 quarters from now in this industry, you're going to be busier again. Your best and your skilled employees, you may want to keep around in one form or another, cross-training, salary reductions, hourly reductions, hours reductions, something to help this process along. I'll tell you a quick story, and I promise not to story you to death today. In the Great Recession, I had a friend of mine named Peter. Peter ran a manufacturing firm, so different industry, and this manufacturing firm in Michigan, he had to lay off just about everybody. I think it actually was everybody for a little while. But as he gathered his team together, he said, leave everything in your lockers. He says, you don't need to take anything home. This will end. And when it ends, you will have a job. I promise you, you will come back to this job. And most of them did. Some found other employment, but most came back. The point is, he inspired the people working for him. They trusted him. He was transparent with them. And he got that skilled, trained workforce back at the end of the crisis. Moral of the story is, obviously, communicate as much as you can. You know that. But as you communicate, you'll do yourself an economic good because you won't have to spend all kinds of money spooling up new employees to fill your ranks. Tough in the meantime, but worth it in the long run if you can pull it off. And that's a cash issue, I understand. which is why we talked about what the federal government is going to help you do. When it comes to wages, now the wage pressure will be backing off. There won't be a lot of raises going out. There'll be some reduction in wages going on. But when we get past this, you'll go back to this. The wage pressure will return. Those rates of change said right before this happened, the rate of growth for the last quarter was 3.8%, and it was likely to get higher. Expect that when we get past this. So in 2021, you're going to find that the wage pressures are there again for you. Don't get lulled into the next couple of quarters thinking, oh, good, it's past, it's all in the rearview mirror. Do not fall victim to the thought that, well, unemployment's at a record high. We were just talking about that today. Some of us were virtually, obviously. And as we were talking about it, it's because some source in the media, and more than one, I'm sure, was saying unemployment's at a record high. That's simply not true. Unemployment's not at a record high. Unemployment, is 5.9 million, and it was a spike for the week, and maybe it was a record high amount of claims for the week, which is what I suspect. But the record high unemployment was actually 15.012 million people back in May 2010. So watch the media. They love the hyperbole. They love the sensationalism. They'll talk about record highs. You got to watch the context. And the context is you're not going to have a very, very large labor pool to pick from. You're not going to find a lot of skilled labor with the skills you want out there, and the wage pressure will be back upon you as we go into the future. Part of your cash planning. The Federal Reserve, boy, have these folks done a good job. They've pumped $1.5 trillion into short-term lending markets in March 12th. You can see that. They cut interest rates, and they cut the reserve requirements to zero. That was key. Lowering the interest rates to 0.25% was good. It was good symbolism, a bit like pushing on string. Because the rates are already so very low. If they were at 5% and they dropped to 0%, it's a much bigger bang for the buck. But cutting the reserve requirements to zero means that they said to the banks, you don't need to keep any money on reserve. You can put it all to work. So banks with a mind to lend, banks with a desire to lend, have the capacity to do so. And they're also putting an incredible amount of money out there in the asset purchases, $700 billion. And we see that they're launching and going to be providing liquidity in commercial paper, primary dealer credit, and lending facilities. I mean, they learned from 2008, 9, and 10, 8, 9, excuse me. They learned how to do this, and they're keeping the credit wheels turning. 2008, 9 was a credit crisis. Everything froze up, and we didn't trust anything. And the Fed eventually came around. This time they came in with both feet. They just jumped right in and said, with their cape on, and said, everything will be fine. We will keep the credit markets working. And that's a big deal. And as it's a big deal domestically, the last bullet point on the March 15th is really a way of saying, and they're making sure to the best of their abilities that credit will be moving internationally, because they understand the United States is part of a global economy. Very hard for us to exist alone. So what the Fed has done deserves our respect. Now, as Austrian-leaning economists, that's not easy for us to say. As Austrian-leaning economists, we don't like all this government intervention, but if you're going to intervene, if you're going to come in strong, they did it the way that we think will work. It will certainly help. And as it helps, it will lead into our forecast that we will be talking about in just a little bit. When we look at what's going on, I would also like you to note, and my brother Brian is the first to point this out, giving him the academic credit that he so richly deserves, the normal yield curve is back in place. Good news for the future when you see that. You want to put something on your wall that says, why should I believe in a better tomorrow? Well, there's one thing right there, and I'm going to show you some more. We're going to look at some economic fundamentals. And as we do, and before we jump into this too far, I'd like you to, oops, I didn't mean to go that far. I'd like you to look at our ITR leading indicator here. That's the green line. And the blue line is retail sales. Obviously very important to the people on this call as you're concerned about consumer activity, consumer spending in the food service realm, whether you're a distributor or manufacturer, wherever your place is in this industry, the consumer is key. And as we look at that green line, it says there is good news coming. Now, our ITR leading indicator for consumer activity is what you're looking at, and we do not think it's going to collapse or that it's going to move down or establish a new low, any way that you want to look at it. We're going to find that this is telling us the future out there. Now, it's going to be a little elongated in terms of timing. I'm going to show you that, but it does mean that there's a reason to believe in tomorrow. Consumers are not going to escape this without paying, and they're not going to keep things going as if there's no problem. I'm not saying that at all. I'm just saying that leading indicator there, that green line, is saying that there's encouragement for the future. And when we look at the Johnson and Red Book weekly indices for retail sales, you can see that department stores are shut down or shutting down. That certainly has a lot to do with that decline. And there's a lot of discount store buying. People are just running out and hoarding, binging, stocking up, whatever term you prefer. And it will fall after that, but it's not going to collapse. As we look at history, we find that it can go below year-ago levels briefly. But if you go back to 2008 and 9, that discount store buying, it was at the absolute worst of it that it dipped below year-ago levels and behaved much differently than department stores. So the people do have money, they will be out there buying. When you look at 2001 and 2, you see that the department stores felt a lot of pain, but discount stores, again, went up. So consumers are not going to be abandoning us, but they are going to be giving us some pause. Let me put it through that way. And as we look at them and their spending habits, their disposable personal income is going down, and that will put some downward pressure on their spending. After we're done hoarding up, there'll be some downward pressure on spending. We're going to find that it's not going to be great, but neither will it be the Great Recession of 2008 and 9, where that center brown line felt all that pain. When we look at another leading indicator that's exceptionally important to us, we look at housing starts. Now, I know that doesn't mean a lot to this industry directly, but it has a lot to do with the forward view for the economy. This is a great leading indicator, and that dark gray line on top, that's the 312 rate of change. I know most of you know what that means. That's a year-over-year growth rate in housing starts, 23.7% above year-ago levels. That's fantastic. And we've taken this apart, and economists on this took point on this. Connor Lokar did a great job. He took this apart. He looked at permits. He looked at similar cases and similar instances in history. We haven't had a triple black swan event before, but we have at other points of crisis. And he came away with the conclusion, and we agree wholeheartedly, this is going to stick. So as a leading indicator to a return to economic health in the United States, this is rather key and rather important. Again, another piece of good news that you may want to keep track of as you go forward. In our ITR trends report, this is one that we track, and we also track a lot of these. Now, at one point, before all this started, in the trend column, it was all green. They all said rise, and they were all saying good news ahead. But we've lost some of these. You can see the JP Morgan Global PMI. It's red now, it's in decline, and we lost the previous low we had in January 2019. But our analysis suggests that this is going to reach a V, that when it comes back, it's likely to bounce back, not do this broad-based U. And you can see the other notes that we have, that our ITR leading indicator, as you drop down about 4 from there, you see our ITR leading indicator, that looks like it's going to hold, that we're not going to lose that trough. That says great things going forward. That's one of our best and most accurate leading indicators. When we look at the US leading indicator, it's likely to lose its previous low. No problem there. Single family housing starts going to continue to go up. So it'll be mixed. Some will hold, like our consumer activity leading indicator. Others will be lost and move similarly to the JP Morgan Global PMI. What I'd like you to do is key in on this with us. Now, I'm going to show you when we're done where you can get a lot of this information from us, and just would like you to have that information so that you'll be able to see these hold, not hold, watch the dashboard, see that our ITR leading indicator and other key leading indicators actually do hold. And if they do, you'll have confidence in the future. Right now, this is enough to say that we can expect the economy will recover as we go out into the future. All right, so far I've covered the economy and I've covered COVID-19. I'm about to go into the stock market, and I'm about ready to talk about the financial markets. And what we might expect there. And but before we do that, I just want to insert something here. Maybe I should have started with this. I don't want to do it here. When this first all happened, my brother Brian and I, we are in our 60s. We've been doing this a long, long time. Brian a little longer than I have. And a double black swan event, unheard of. And then we had massive government intervention, $2 trillion, and the massive monetary policy by the Fed, unheard of. And so we took a step back and go, what do we do? How do we analyze this? And so, like good economists who love numbers, we decided to look at the numbers and said to ourselves, okay, what is this like? Well, the oil part of this, where Saudi Arabia and Russia are fighting over market share, and Russia is most likely aiming some arrows at our fracking industry because they don't like our fracking industry. This is a great opportunity to ruin the fracking industry in the United States. And we thought, well, we've been through that before. That was 2015 and 16. So as we were looking into the future, we said, okay, we've got to keep 2015 and 16 in mind. Done. What about COVID-19? Well, that's a fear issue. I mean, there is the actual issue, but it's behind that. There's fear. There's fear of dying. There's fear of the unknown. There's the uncertainty of it all. And of course, we flash back to 9/11 and the fear that was there. That's 2001. So we look back to 2001 and we said, all right, what does fear do? How long did it last? How long before the government intervened? How long from government intervention till the economy picked up? Now, keep in mind, in 2000, 2001, we were already in recession, a recession we forecasted well in advance, a recession that was no surprise. So we have the fear that came in after we started into recession, but nevertheless, we can still look at the intervention, how long it took, and how people responded to the fear. And that was very instructive to us. And we also looked at 2008 and 9, a really tough economic time, and said, all right, are there lessons to be learned there? And we went back to the 70s, and we did other look backs, but the primary three were 2015, 16, 9/11, and then the 2008 and 9 scenario. And as we looked at all that, we came up with some interesting takeaways. Now, I want you to know that before we talk about the financial markets, and I want you to have a construct for the forecast, because we're going to get to those before too long. All right? Okay, let's go forward. Into the financial markets we go. And as we go into the financial markets, here's where we are today. The blue line being the S&P 500 Industrials monthly data trend, and of course it's about collapsing. Now notice though, and this is one of the points that I want to make sure that you catch, is that when the S&P goes down, it doesn't mean that retail sales have to go down. There is not a strong connection there. It did in 2008 and 9. Retail sales followed the S&P 500 monthly number on the backside of the business cycle. But in other cases where we had moderate to even more severe drops, we did not find that the retail sales numbers slowed down. So when we get to retail sales, I want you to divorce it in your mind from a lot of what's going on here in terms of the bear market. And I'm doing this because one of the questions I will often get is, well, yes, but until the stock market gets better, retail sales cannot get better. And the reality is they're not that tightly connected. You can't make that statement. So just separate the two. Now, and I know you're going to be thinking, what about feeling? If people aren't feeling good about their 401ks, their IRAs, their investments, they're not likely to spend. I didn't bring the chart for you because I didn't want to chart you to death, but I have a chart that shows you that consumer expectations, feelings, sentiment, confidence don't have a lot to do with how we spend. There have been lots of times in history, actually since Iraq War 1, where we have felt really good and just kind of continued on our merry way spending at a constant level. And then there are times when we felt really bad. I mean, for years, it just kept kind of ratcheting downward. And yet we just kept spending along our merry way. And so the natural conclusion is sometimes we spend with no confidence, sometimes we spend with great confidence, but overall you can count on the spending. And that's a key factor because you're going to hear a lot, I think, in the media going forward about consumer confidence, consumer expectations, stock market. And I wanted to make sure that you had a healthy distancing of the two thoughts in your mind. And this is as of yesterday's close. The red line is yesterday's close in the S&P 500. monthly number, and it's significant, absolutely. But you see the other declines that are like that, go back to 1987. Do you remember 1987? That was quite a decline too. And you can find other instances, maybe not as severe, but they certainly were there. You can look at 2009 and see that there's a very steep slope there. And one of the takeaways you can get from this without looking further than 1980 is that when there's a sharp decline, there's usually a sharp rebound. There's a nice V kind of shape at the bottom. And we're looking for that nice V shape. Now it doesn't have to match the slope of the way down, but you don't see these really broad elongated U's. You don't see this being a slow crawl out. You see this being more of a snap back as we go forward. Oops, excuse me. When we look at the stock market, stock price index, that's the blue line here, and we look at non-financial corporate business liquidity assets, you can see there is a cyclical identity where the stock market leads. That's why the blue line's in front. And that sharp decline in that blue line in the stock market, stock prices index, says that there will be some liquidity problems in the non-financial sector as we go forward. There's going to be, for certain, some downward pressure on profits that will slow down some spending on the B2B level, and that will slow down some cash intake to the federal government through taxes. It'll put pressure on businesses. They will say no more often. If you're finding your corporate profits being squeezed, and I can't imagine that most of you are not, then you already know the old maxim is true, cash is king. We're going to talk about how long to plan on that, but it is going to be all about cash as we go forward. Then it's going to be all about planning your cash for the way up too. There's two times that we go out of business, right? On the way down because we don't have enough cash, and on the way up because we don't have enough cash. So what we're going to end up talking about before we part company today is that we want to make sure that we're doing everything on the way down to make sure we have enough cash on the way up. I hope you're talking to your banker every day. Maybe not every day, but regularly. I hope you're as transparent as the day is long with your banker, that your LOQs are in place. See about expanding them, talk about covenants. Maybe you can get more favorable covenants given everything that's going on. Everything you probably already thought of, but as an economist, I thought I would bring them up in case you need a little nudge to move in that direction. And we've already covered the Fed, providing a lot of intervention and a lot of help to a lot of businesses and individuals along the way. Certainly a good thing. Now, where are we in this cycle? Well, there are certainly opportunities to be had, and we've gone through the fear and panic part on the downside. It came upon us really quickly, and there was no lack of fear, and there was no lack of panic. Hopefully, you did not sell in the fear and panic phase, because that's a great way to just lock in your losses. The question is, are we approaching capitulation, where we actually trough? That's where we accept that things are going to get worse and the world's a bad place, and we just kind of give into it all. When you find that giving into it all going on, that's actually a pretty good sign, because that usually means you're getting near the trough, and pretty soon you're going to have hope because the situation won't keep deteriorating. Things will begin to level off, and as they level off, you'll find hope. So what you want to do, obviously, is buy somewhere in this capitulation phase between capitulation and hope. There's no point in trying to time a trough. We don't try to do that at ITR Economics, but there is certainly a way to grab that swing up, and through tranches, you can work towards that capitulation point and make sure that you're buying near that trough. Set tripwires or road signs for yourself. When the market gets to X, I will put in Y. When the market gets to X plus 2 or minus 2, I will put in more money. And when it gets to 3, I'll put in more money. So you're building this cash portfolio where you're taking your cash and building a portfolio that you can take care of the run up. Now, I did not make that up, obviously. I'm leaning on two friends. One's a very good friend of Brian's, Chris Didier of Baird Family Wealth, and our mutual friend of Brian and I, who we trust implicitly and we do business with, which would be Clark Bellin of Bellwether Wealth Advisors. They are excellent at their jobs, which is why we work with them and trust them so much. And as we look at what's going on and we talk about those tranches and those cash, if you want to know more about how to do that, the signs to do that, the best way to do that, I would be happy to connect you with Clark. You can send me an email at the end, and I would be happy to just make an email introduction. He will also talk to you about something that we have developed called the ITR Optimizer. The ITR Optimizer is a great tool for taking advantage of upswings and minimizing normal cyclical declines. Clark can walk you through all that at the same time. I'd encourage you to talk to your own wealth advisor about that plan that I just talked about if you haven't already, because we appear to be nearing that. Again, we don't want to call the low, but it's beginning to look encouraging. And if you would rather just talk to Clark, he'll be happy to get on the phone with you. All right, 7 previous precedents are very similar to what we are seeing here. What happens? Well, in these cases, the market has rebounded for a duration of 11 to 26 months, maybe slightly longer. But there's been varying lengths of rebounds, kind of a V shape. So if we rebound soon, let's just pick June. If we rebound soon, that means that the next rising trend could last until May 21, or could last 2 years past that. So we get to July of 22. But it does mean there's a nice path upward, and there's a time to recoup. Probably more importantly, when the market rebounds after those 7 pertinent precedents, it rebounds nicely at 56.5% to 85.5%. Depending on where the trough is, that makes you whole again and put some money in your pocket. It all depends on where the trough is, depends on where your money is parked, but there certainly is an opportunity there and some reason to be optimistic about the rebound on the other side, and a reason to make sure that if you haven't gotten out of the market, you don't get out now, because if you get out now, the chances of you getting back in at the right time and not missing out on some of this rebound is fairly slim historically. So you just leave it where it is, talk to Clark or talk to your wealth advisor. The length of the rebound doesn't determine the strength of the rebound, so just take that off the table. If you're hoping for a long one, that's fine. I guess everybody likes good news for a long time, but it doesn't mean that you'll crowd that 85.5%. There is no relationship there. The median gain in all cases is 60.8%. So that'll cover quite a fall. If you're down 30, you gotta go up 60. So if we have a median rebound of 60.8%, it certainly would be welcome news for all of us that still have money in IRAs, 401ks, etc. So the market, not saying it's at the low, but it's certainly beginning to feel better. We've had some nice up days in the last few years. It's only seemed like years, excuse me, last few days, but it does seem like it's been years. Today, the market's down a little bit. The S&P was down slightly. Overall, please don't wait too long to act, is the message behind that. Now, we often hear about the debt of businesses in the United States as well, and the non-financial corporate business debt and loan liability level as a percent of GDP at a record high, and certainly this is detrimental to the long-term health of the country. Certainly this is part of what's going on, and different views are spun from there. It is high. I mean, you can look at the graph, you know that it's high, and that's as a percent of GDP, not in dollar amounts. If it was just a dollar amount, of course it'd be higher, but as a percent of GDP, it is a problem. Only if interest rates are high. When interest rates have been low, like they have been, that's an affordable debt level. You need to look at delinquency rates to see whether this is a problem, and delinquency rates are showing this is not a problem yet. This could easily become one of the problems leading to the Great Depression, because if 46.6%, we go down a little bit here, we come up the other side with ascending peaks, and it finds its way, let's make up a number, 55% at 1% interest, not a big deal. 55% at 7% interest, that's a big deal. So as we go through the 2020s together, let's watch what's happening to this percent of GDP that is debt and loan liability, and let's watch interest rates at the same time. But when you hear somebody today saying this is a problem, this is going to be part of the curse, and this is why the Great Depression's here now, just walk away. It's fine. Everything will be okay. All right, macroeconomic trends, what's going on? As we look at macroeconomic trends, we get into our forecasts. And again, we drew from 2008 and 9. We drew from 9/11, and we drew from 2015 and 16, as well as a few other years, as I mentioned, the 70s and a few others, to come up with our forecasts. And what you have in front of you in the spaced bars on the right is the forecast. Solid blue bars are what has been. We have been forecasting the first quarter would be down. And we've been forecasting that for a long time now. And of course, it is coming down. You notice that second quarter 2020 where that red arrow is, that's a hummer of a decline. That is not pleasant in any way, form, or manner. We'll get back to that, but I just want you to know that that decline that you see there in the 3-month moving average, that's what you're looking at, looks very steep. But the first to second quarter decline is not a record breaker. It's not a right home to the kids. You'll never see anything like this again. It is sharp, but it is rather V-shaped. This is not that long drawn out trough. If you look back to 2009, you see how there was that broad U. We're not looking at a broad U here. We're looking at a snap. And as we touch down in the second quarter, we are convinced because of the cases that I showed you, because of our view of the stocks market and interest rates and the Federal Reserve and the stimulus package and all of that, that we're going to see the economy come back on a GDP level. And oil does not have a big impact on GDP. So we're going to see us come back, and before you know it, it'll be 21, and 21, everything will be smelling of roses and sunshine, and consumers will be spending in cafeterias, consumers will be spending in restaurants. They'll probably be packing restaurants because they're so glad to get out and eat again. We're going to find universities open, cafeterias open. We're going to find that in this time period called 21, you're going to enjoy life. And if you've heard us in the last couple of years, you've heard us talk about 22, 23 being a pretty noticeable recession. You can see that it's gone. You see that we have a little decline in GDP out there in 23. It's very small. And that's because the imbalances have been taken out early. This COVID, oil, Fed double black swan event seems to have taken the excesses out of the system and brought them in. And our cyclical theory says, well, that's good, because as it's brought in now, it means that we don't have to pay the price for it later. So if you've heard us talk about 22, 23, be careful, significant downturn, steepest since the Great Recession, et cetera, it's been moved in, not for straight economic reasons, but the COVID virus and the oil fight is certainly working to our advantage as far as 22 and 23 are concerned. You're going to enjoy that run up. You're not going to be terribly bothered by that softness out and through there. On a rate of change basis, I think it draws a very interesting picture. Now, the GDP that is and has been is in the dark blue. The forecast is in the light blue. Normally, we present forecasts as dots, but when they have that much swing, it becomes more like a scattergram. I want you to see the fall off. Notice that the trough in the 312 rate of change, which is the quarterly growth rate, that trough that we're looking at is not far out, June. And notice, please, that it's not nearly as far down as the Great Recession. Yes, this is steep, but notice that it's not as long and it's not as far down. So I hope that helps with the context. And notice the V shape on the way up. And we're back up to a very healthy growth rate before long. And then 22, 23, the economy slows down, but it stays above that zero line. Zero means 0% growth. So we're going to stay above the zero line, and then we're going to spring back up on the other side. It's not to say there won't be recessions in the future, but once we get past this one, it'll be a few years before we have to use the R word again. We'll be talking about slowdowns, we'll be talking about opportunities, we'll be talking about interest rates and inflation and lots of things as we go forward, but we won't use the R word for a little while. When we look at our gross domestic product forecast and series and compared to the ITR leading indicator, that green line shows you there's some reason for that optimism. See that green line, then go straight down from there. And you can see there those dotted lines going up. So that green line is telling us to expect that trough, that first diamond at the bottom is coming. And it makes sense with the timing, a little elongated, which you would expect because of the black swans. So that rising trend is not just based upon theory, it's based upon something that has happened called the ITR leading indicator, which is certainly good news when there's something empirical to point at. When we look at the stock market, we circled those areas so you can see that GDP in the stock market can be disconnected. That this is not the stock market is not a reliable indicator for GDP. It certainly has its times, it certainly has its place, but it is not a locked in. And we think we're at one of those times where we're just not going to be locked into a tracking with the stock market when it comes to GDP. Both will recover, both will be moving upward, but the stock market, even if it flounders for a little while, even if we're not at capitulation yet, doesn't mean that we can't have GDP moving up beginning in the third quarter of the year, seeing that rate of change move up. On the U.S. industrial production basis, we have this 12-12 rate of change forecast showing you that the economy on the industrial side, which is mostly manufacturing, also includes mining and electricity generation, will be on the backside of the business cycle, but we were on the backside of the business cycle. We have been on the backside of the business cycle for quite a while. It's just going to go negative now. We had it going negative before, but at minus 1.2% at the trough. This is twice that trough, but as twice that trough, it's because of the black swans, but it's pushed out a little bit from where we were before because of the black swans, but it's not an entirely unheard of situation. We have consumers slowing down, businesses shut down. So of course it's going to be a little deeper. Of course it's going to be a little further out, but you can see it's pretty much the trajectory that was in place before with a nice recovery on the other side. Notice that that highest blue diamond out there in the future is above the previous peak. So we're going to see a very nice recovery in terms of the rate of growth in industrial production. And when you look at these diamonds, you'll notice that I have that big arrow there showing you that the 3-month moving average decline that's we're in now and that will continue is not nearly as painful as 2009, excuse me. And that when we get to the other side, those diamonds are above where we started from. And then when we get out into 22, 23, they're above where we started from. So we will return to growth. I hope that doesn't seem too obvious, but I want to stop on it because I hear people saying it's going to be years before we get back to where we were. And we say, no, we're going to reach that trough. We're going to begin our way up. And before you know it, we're going to be in 22 and we're going to find that we're above year ago levels. When I say years, people mean years. They don't mean get through 20 and 21. They mean, 23, 24, that this is just going to knock the wind out of the economy for a very long time, the global economy, and the pain will never stop. And it's a terrible conversation to have with somebody. Best thing you could do is walk away. The reality is we're going to bounce back. We're going to be in a growth mode. You're going to be back to being busy again. And please don't lose sight of that. States with stay-at-home orders. That certainly has an impact on you. And with restaurants shut and only doing takeout, universities, cafeterias, business cafeterias in those states, and in the states where it's ordered in part of the states, every star there is a city. It's tough on just about any part of the country. Wherever you happen to find yourself, you're going to find that it is certainly difficult. And in that difficulty, it all comes down to the consumer. And as a consumer-led business, let's take a look at retail sales. Retail sales, we're doing well. The top gray line is the quarterly trend in retail sales, and that quarterly trend in retail sales was positive. The 12-12 rate of change was rising and looked really good. We weren't expecting it to last, though. We were expecting that 12-12 rate of change to just kind of gently move lower, not reach the zero line, but gently move lower as we went through 21. So we already thought that that bottom green line, which is the amount of money being spent, was going to slow in its rate of rise. But because of stay at home, because of the layoffs, because of fear, because there's not a lot of places to spend your money because the stores are closed, can't all go to Walmart, deliveries through Amazon have slowed down, and it certainly depends upon what you're going to be buying, whether they'll ship and how soon. Because of all of that, we now have a forecast that shows that the rate of growth goes negative and that by the end of the year, we'll be down to a minus 1.3%. Quick look to the left shows we didn't even see that back in 2000, 2001. We saw that in the Great Recession, but it was much worse back then. There's no way around it. Consumers are going to be hit for cash, and they're not going to want to spend a lot of cash. But then it bounces back and the rate of growth picks up nicely. We're back into nice growth territory. Then it slows down again. Instead of a steep 22, 23 recession, mid 22 to mid 23, we just have a slower rate of growth, not enough to take the economy offline, but enough to soften that rate of growth, that lull that we were looking at earlier in GDP. You look at the bottom diamonds, you can see that it actually moves lower. That's a pretty rare event. For us to forecast a decline in retail sales is not a little thing. It's a rather large thing. But as you follow those diamonds out, you can see that when you get out into late 21, we're back up to record high levels. Christmas of 21 will be a good Christmas. People will have money to spend, which means they will be spending money on you. I'd like you to burn this forecast into your memory. I'd like you to take note of the fact that even though it's in decline on that bottom green line, the 12-month moving total, the rate of decline is mild compared to the Great Recession. In 2008 and 9, the 12-month moving total decline was 3 times steeper than what we're going through now. So please don't let your mind go back to then, except to ask yourself, what do I wish I had done in 2008 and 9? If you ever said to yourself, if it ever happens again, I'm going to fill in that blank and do it, maybe not to the same extent, but if it had to do with cash planning, if it had to do with cutting costs, if it had to do with decisions you would make differently, maybe not quite as dramatic as they were, it's a good time to enact those and to be thinking about, okay, what am I going to do? Because this decline, that's 2020. When you look at the rate of change and the dollars being spent, that's 2020 that's in front of you, that's going away. And that 12-12 trough at the top actually is in the first quarter of 21. Excuse me, the bottom 12-month moving total actually reaches a low very late 2020. So this year that's your future. Excuse me, let me settle in on it. There we go. As we relate retail sales, which is now the brown line, and compare that to retail sales for food services and drinking places, you can see the similarity. And when we look at this, we can take several things away. Retail sales, food service and drinking places obviously going down because of the stay-at-home shuttering of restaurants and bars for gathering. When we look at the personal consumption expenditure for food and drinking, that was going up pretty much the same as the blue line here, but it is also going to be going down because it also just marches with the retail sales forecast. Fast food is going up, is going to continue to go up. It's one of the few options that people have, just probably not the same pace as more people are staying home, not going out, but not expecting a collapse there. Convenience stores are staying open. So if you're selling into the convenience store market, there is going to be opportunity there. They're likely to be busy. People still go out for convenience stores for whatever they sell and for gasoline. When we look at the grocery stores, obviously that's the place to be. As you're servicing grocery stores, you're not going to lose. I mean, people are lined up. People can't wait for a product to hit the shelf. It's flying off as fast as it can get there. If you happen to be serving liquor stores, I guess it depends on your state and whether they're state-run liquor stores or whether they are commercial, whether they can continue to get sufficient supply or not. I happen to know that the one that I frequent relatively near my house has gone from 2 deliveries a week to 1 delivery a week, and then it's a smaller delivery, which in turn kind of speaks to the things are still going to tighten up even for people that are supplying alcohol. They can't get it fast enough. Too many people want it too fast, and it creates bottlenecks and supply disruptions will occur. It's not for a lack of demand, it's a lack of capacity. So that brown line kind of speaks to everything. You're going to find that people's ability to spend, that's personal consumption expenditure, how much they will spend will go down with it. Retail obviously will do well. Food services in terms of restaurants, bars, going to feel some pain. That forecast is one that would be interesting to take your rate of change and compare it to that retail sales trend line. As you do that, you might see that you relate very well to it. You might lead, you might lag, you might have higher amps and lower troughs. You might find a relationship there that is nice and visual. I want to give you an easy way to do that. I'm not selling you anything. Please don't get nervous. I want you to go to our website and you can do a free trial of something we call DataCast. And it'll be explained there. There'll be a wonderful lady named Ann who will pop up and ask you if you need help. If you need it, she's more than happy to help you. With DataCast, you can put in your revenue numbers and it'll convert your revenue numbers to rates of change. It'll convert your rates of change to series that we carry in our ITR trends report, and this is one of them. So you'll be able to see how you relate to different things like retail sales and to various leading indicators. And as you do that, you get a sense of your future as a result of listening today, coupling that with what you can learn about how you fit into the economy. Then you make plans with a lot of confidence. When we look at the wholesale trade of commercial equipment and supplies, which is where we find other people on this phone call, the ITR leading indicator is a good leading indicator. It's going to have an elongated lead time now because of the Black Swan event. But nevertheless, as it continues to go up, it builds confidence in the fact that that dotted blue section is going to be going up in the future as well. So things are going to sag right now. B2B is off. Not plummeting, but it's not, neither is it going to be pleasant, but it will go forward in the future. When we look at wholesale trade and compare it to non-defense capital goods new orders, the cap goods new orders is certainly going to rebound later this year. And as it rebounds in the rate of change late this year, actually I think it's first quarter 21, it speaks well to improvement in the wholesale trade of commercial equipment, which again is where we find ourselves. When we look at our ITR leading indicator to that same wholesale trade trend, now I've time-lapsed it. You can see what I was trying to do verbally before. Time-lapse, it shows you that you can have confidence in your future. When we look at it right before all this started, it was already on the backside of the business cycle in terms of the rate of growth, wholesale trade of commercial equipment, where we find this industry, rates of change were signaling slower growth. Obviously, it's going to slow even more. It's going to become more difficult as you go forward, but I've shown you, I hope, good reasons why you should expect that 21 will be heading back in a positive direction, getting stronger, better, and that you need to plan for that as you go forward, inventory, sales, marketing, etc. All right, so the retail sales forecast again on a rate of change basis. Please see how you fit and what's going on. All right, with that in mind, I want to extend this another free offer to you. Besides DataCast, text TR space trial to 33777, please. And for the next 90 days, you're going to get our ITR trends report. This is our premier subscription product. You'll get it for free, and you'll get asked for your email address automatically. Please put in your email address. You'll be given access to our on-demand, so you can get this information when you want it, as you need it, at your fingertips. Couple that with the DataCast, and I think you'll be amazed at what you can see about your future. And as you do so, we think you'll be able to see your way through this in fairly short order, make plans that will get you through this. I also invite you to follow us for free at those social media outlets. We blog, we vlog, we have podcasts, which we call Trends Talks and Trends Talk. And what I'd like you to do is avail yourself of that, because we're always talking about what's in the media, what's going on, things that we think people need to know. Our mission in life is to help businesses do better. Our mission in life is to help businesses succeed, because we know by helping businesses succeed, we help people to succeed. We make things better for people. We want to partner with you on that. This is a free way to do it. And then as we go down the road, stay in touch with us. We'll be here for you. All right, Dawn, I'm ready to take whatever questions come our way, if there are any.
Great. Well, thank you, Alan. We do have a few questions for you. I've gotten several questions, and I'll take this one. I have been asked, will we provide a PDF of the PowerPoint and a recording of the session? And want to assure you that those will be provided to your respective organizations. So that takes care of all of those questions. The first question I have, Alan, for you is, my state's governor is about to extend our shelter order through the end of the month. If other states follow, those that are currently on the April 6th or the April 12th orders, how will that impact recovery? Do you see that having an impact?
No, because we assumed they would be extended. Short answer, I suppose. We assume that most states will go through April. Our New Hampshire's May 4th, and can't imagine that too many will release before that.
Okay, thank you. Additionally, what contingency plans would be needed if this virus extends and it revisits, or we have another one such as this in early 2021?
If it revisits, rebounds, second wave, all those things I imagine are wrapped up in that. What contingency plans you have would be depending upon your individual business and your position, and don't mean to hedge, but it really does. For most of us, it means, do I have enough cash if this thing bounces back? Is my relationship with the bank strong enough? And do I have a cost-cutting measure playbook on the shelf so that when it comes back, I don't have to talk about this. I don't need to debate this for even a week or two. I just pull that plan off the shelf. If it's lay off 50% of the workforce because we just can't take another round, then you already know you're going to lay off 50% of the workforce. You already know who they are. If it's 50% pay cuts on senior staff, whatever it happens to be, shutter operations, close down the one in Oklahoma City, make sure that we are doing this in New England. Whatever works for you, write it out, agree to a leadership team in advance so that you're ready. So it's cash, bank, have the plan ready.
Great, thank you. One of the things that we see are that petroleum prices are often linked to food service sales. Are low gasoline prices a good omen when that we should watch, or do they even matter in a situation such as this?
In a situation such as this, it's not a factor. Whoever asked that question, your analysis is right. Normally, you could find that, you know, it's good. It frees up some discretionary spending cash for people, not as much going into the gas tank, or we're just out for a drive, whatever it happens to be. But now they're not coupled together. And if the problem with Saudi Arabia, Russia, and the United States, as far as our fracking industry, actually grows in the future, it'll take some energy, excuse the pun, out of the recovery, especially on the industrial production side. We could find industrial production recession getting worse as we go forward if this lasts more than 60 or 90 days. Traditionally, it won't, because it's painful for them too, but it's political, and not everybody is worried about consequences, shall we say, through the longer term.
Next question, and I believe you covered this, but maybe you can give a couple more minutes to it. Do you believe that people's spending patterns are going to be the same, or will buying patterns change?
I assume that means on the other side, when
Yes.
sanity returns and we're traveling and out and about again. Interesting sociological question, and not one to be taken lightly. My answer would be, because this is going to be relatively short-lived, because this is not going to be a protracted zombie apocalypse, or we're going to stay at home for 6 months and learn new habits and all the rest of that. I think when we're let loose, we're going to let loose, and we're just going to go back to our favorite restaurants. We're going to go back to our sports teams. We're going to go back to doing all the things that defined life before this, because it won't have been long enough to develop new habits or to break old habits. We love social economics here at ITR, and that would be my personal take on the situation. All things will go back to normal.
Okay. How do you think this crisis will impact businesses' appetite for capital expenditures? Do you think these will come back in May 2021 or sooner?
Interesting to pick a particular month. I'd love to know what that's about, but
Maybe it was supposed to be May 2020.
Oh, okay. No, the answer to that's no. I think what you're going to find is the pain of the second quarter is going to keep people from making capital expenditures in all kinds of industries, including this one. It's going to be a significant downturn, stock valuations down, et cetera. There'll just be a lot of no's on the lips of CEOs, CFOs, purchasing managers, although purchasing managers will be doing a lot of poking and prodding, looking for better prices. When you get into the second half of this year, you may find the attitude shifting, but I think there'll be something of a hangover. Our non-defense capital goods new orders forecast, excluding aircraft, calls for that 12-12 rate of change, which is the annual growth rate, to go down into the first quarter of 21. So that's why the May 21 reference struck me. That second quarter of 21, yeah, that's probably a pretty good time when you're going to notice it. Some of you will notice it earlier than others, depends on the geography and your industry and who you're serving. But there will be the GDP will be going up. You're going to find the news media is picking up. We'll be on to other stories, and you're going to be wondering, why not me? It's because of that hangover that comes through this, and the capital will be a little slower to be released. On a quarterly basis, we'll see stirrings and some improvement late in this year. First quarter, a little more, and then you're going to find yourself probably in that second quarter breathing a lot easier.
Okay, another attendee is curious whether your economic projections include the trillions of dollars of stimulus, including phase 4.
It does. Short answer.
Okay. Great. Do you happen to see one market segment rebounding faster than another? For instance, healthcare, college, university segments be more likely to build a new or remodel than perhaps a business or an industry segment?
I have not studied the various segments in enough detail to give you a answer with a high degree of confidence. I can give you one with a low degree of confidence, understanding that this is not a result of rigorous study or preparation for that question. I know that's quite a caveat, but when I just want to make sure it's out there. I think you're going to find universities not coming back vigorously because they were struggling, a lot of them financially before this. They were struggling with attendees. They were struggling with cash. And with the stock market having taken a hit, there's a tendency for giving by those folks into things like alumni funds to go down. So you're going to find, I think, that the universities are not a strong rebound right away. That's more of a slow build. Hospitals and medical facilities are taking a bath financially right now as they've shut down a lot of operations and a lot of normal procedures in anticipation of massive COVID patient influx. There's a lot of beds waiting and a lot of activity that's not generating any revenue. So I'm not sure that you're going to find a lot of cash there immediately either. There's a big financial hit that has occurred in those sectors. That leaves us with the business sector. And I think you're going to find the business sector brings back people faster who have money in their pocket who want to spend. So top of the head forecasting would suggest that that is the strongest of the three places as you get out later this year and into 21.
Alan, is it a good idea to take the SBA loan forgiveness loan? Will this spike the economy and rebound faster? And what are the pitfalls of this loan or potential pitfalls of this loan for a small business from your perspective?
I'm not an attorney. I appreciate the question. Best thing to do is have your attorney read the regulation and all the details of the loan. But from my own readings on it, I think that it is helpful. I think that it can help many small businesses survive. Many small businesses, because this is a lot of that is a payroll payback feature, so that it preserves jobs. It keeps your trained workforce in place. It provides you the cash to keep them in place with some operating capital. Then if you meet the guidelines and qualifications, it is all forgiven. So you've gotten a nice bridge loan and probably don't have the, and perhaps don't have the payback on the other side. For many firms, that's how they will stay in business. For others, it'll just make it possible for them to have that cash in the future, not the cash that they're going to be getting for the loan, but cash that would be drained away otherwise, so that they can get ready for busier days, they can get ready for training, new products, whatever it is they have to do. I don't know if there's a sharp barb in there somewhere that's going to catch us all, but that's what attorneys are made for. But on the surface, it looks like it's something to be pursued.
Okay. Do you forecast a long-term effect on global manufacturing partnerships, specifically China, due to trade agreements or potential lack of faith?
Forecast is the word I'm stumbling over there. We think what's going to happen, and my brother was the first to bring this forth, again, very smart guy. We think all of this is going to make a lot of people think, again, I have this disruption again, because we've had SARS, we've had MERS, we've had other things come out of China that have been very disruptive. We've had trade wars, we've had political kerfuffles with China. And the thinking is that this will cause a number of firms to say, you know, I'm done. I have to be in China. Yes, I know I have to be there to sell into China and to get certain parts, but I can start thinking about +1. And we've been telling people this for years, by the way, is China +1+1. The +1 is, all right, should I be in Vietnam too, or Thailand, Cambodia, Malaysia? Should I be somewhere else in the region? And the second +1, China +1 is you need to be in another part of the world entirely, think North America, because that's your safest supply chain. And there's an interesting study by the Boston Consulting Group, which can be found online, I'm pretty sure, I haven't looked for it in a long time, that showed that the cost of manufacture in many areas, not all, and all in, including freight and such, in the United States is not much different than what we're talking about in China. Now, again, it depends upon what we're talking about, but there's a reason why a lot of manufacturing had been coming back to the United States even before all this, even before the trade wars. Manufacturing was finding its way back to North America. A lot that left Mexico came back to Mexico. A lot came back to the United States. And that's likely to continue to be the case as we go forward. I feel like that's probably a long answer to the question, but this is not the only reason, but it's likely to provide additional urge for businesses to think, I need to source domestically. Global partnerships then are frayed. Europe and the United States, we've managed to antagonize each other a little bit. The face of Europe is changing, and the relationship gets a little more difficult as we go on. Relationship between Canada, the US, Mexico and the US has gotten stronger. The USMCA will help a lot of businesses. It will hurt some. We don't generally come down in favor or against pieces of legislation. We look at it from an economic point of view. Economically, it'll help some businesses do more business. It streamlines business. It reduces some old regulations and paperwork, computerizes some operations, removes redundancies, and should make for more business in North America. All those things say that those partnerships strengthen, and the transatlantic, trans-Pacific partnerships may be more in question.
Alan, could you give us some maybe insight into the K-12 school market? Do you think it will rebound based upon the economic stimulus? And do you anticipate there being more of a cash-infused segment?
I do not know. I'm afraid I have not looked into how much cash is earmarked for that segment. States will not have a lot of money, so the states will be receiving some money from the Fed, but in 21, tax revenues, tax receipts into a lot of states will be down because of the recession of 2020, which will make it difficult for them to, in state schools, state funding, to provide what you're looking for. And I don't know how much money is available through the stimulus program and how easy it will be to get in target K through 12. Population growth is there. That's the good news. It's a question of whether the money will be there. I'm afraid I don't know. I'm worried because of the tax revenue part of the equation.
Okay. Do you see the U.S. going back to a gold standard with the Fed being less effective since we are in a zero interest time?
No, we don't see the Fed going back to a gold standard. It's a very difficult thing to do. It's a common thought, and it's a good thought in many ways, but it's not an easy thing to do. And actually, if you were to look at all the fiat currency in the world, or even just in the United States, and try to go back to a gold standard, it'd take more gold than you can possibly imagine, or you'd have to bring gold up to an outrageous amount per ounce, in which case you'd be creating a lot of billionaires overnight just because they have to be holding gold. It's tricky, take a long time to do, and I'm not sure there's a felt need to get there.
So Alan, this is a question for you that where would you look for relevant information about what is happening without the, to get information on these economic indicators and where we need to be getting our information from, rather than perhaps the news networks that don't always carry the most helpful information?
That's a very well put question. Whoever wrote that, I applaud them for their approach. Well, a couple of things come to mind. ITR, we have all that free information available to you, and we get from a whole lot of sources. We name sources, so you're more than welcome to use ITR as a primary source of information. We do not get excited. We're not an emotional group. We tend to look at the numbers. Johns Hopkins also has a very nice dashboard on the medical front, and that's been a good source of information as well. There's another source I just came across. I'm a little hesitant because I haven't done a dive into it yet, but a fellow I trust goes and uses this. It's worldmeter.info. You might want to take a look at them. We are, as I said, sourcing from many places and looking for data to back things up rather than just excited utterances. So again, ITR, good source. Johns Hopkins is another source, and probably just go to the sources that we quote and use in our blogs and in our talks, that sort of thing. I think you'll find what you're looking for there.
Great, thank you. And then I have one final question. I think we're getting close to our time, and then I have some housekeeping items. Can you share the link again, Alan, that allows one of our attendees to enter the revenue and the industry segment and calculate those projected changes?
Sure, I'd be happy to. Happy to. Go to itreconomics.com. Okay, itreconomics.com, and then look for DataCast. I think it's along the ribbon along the top. Or when the chat box opens up, just ask Ann, who is a real person, by the way. She's a wonderful lady, and just ask Ann about the trial DataCast, D-A-T-A cast, C-A-S-T, and she'll take care of you from there. Or if you want to do it on your own, again, I'm told it's easy to find. I also want to give you my email address, everyone, so that if you have a question about the tranching and you want to see more about the ITR optimizer, you want to talk with Clark Bellin about what I was talking about, get some ideas from him, he'll be happy to talk with you. My email address is Alan, A-L-A-N, at itreconomics.com. And I'll be more than happy to introduce you to him or answer the question if I can.
Well, thank you, Alan. For our attendees, again, your respective organization will be provided with a recording of today's presentation and the PowerPoint. And thank you to Alan Beaulieu for today's insightful and informative session. And thanks to all of you for attending today's webinar. Have a good afternoon.